Today, we're going to speed run HELOCs for investment property, the 284K in untapped equity most investors never touch. So since 2020, home values have risen 45% across the US. Average homeowners now sitting on 284K in untapped equity, deployable capital that can fund your next investment property deal without touching your savings, without an equity partner, and without giving away a cent of your own profit. So welcome to Gap Funded. I'm Mick Wadley, founder of gapfunded.com, and we cover how to fund real estate deals without using your own cash, giving up equity, or handing profit to a partner. What we're covering today is layer 4 of the gap funding method, home equity. HELOCs versus home equity loans on investment deals, and how they work alongside hard money, gap funding, and 0% business credit card stacking. How to get deals fully funded and scale faster. So for a free funding review at gapfunded.com/book, link in the description below, just a soft pull, no hard credit check or commitment. It takes 2 minutes, and worst case, you walk away with a game plan. So what is home equity and why does it matter? Home equity is the difference between what your property is worth and what you owe. So if your home is worth 400K and you owe 250K, you have 150K in equity, collateral you can borrow against. So for real estate investors, it's one of the cheapest and most accessible sources of capital available, activated quickly at much lower rates than hard money, and usable flexibly across multiple deals. The two products that access this equity are HELOCs and home equity loans, and they work a little bit differently, and knowing which one to use matters. So let's get into HELOCs versus home equity loans. What is the difference? A home equity loan is a lump sum borrowed at a fixed rate over a set term, typically 5 to 20 years, and it works like a second mortgage, predictable monthly payments. It's best for a specific known cost, a large down payment, a scoped rehab budget, or a single acquisition. As opposed to a HELOC, which is like a line of credit. It works more like a credit card backed by your property. It's a revolving line of credit secured against your equity, draw, repay, and draw again during the 10-year draw period. Pay interest only on what you've drawn. That's the major benefit there. So it's best for active investors doing multiple deals, draw for a deal, repay from the sale, and draw again for deal 2, or run multiple projects at once. The key difference, a home equity loan gives you a pile of cash at once, and a HELOC gives you a tap you can turn on and turn off. For active investors, the HELOC is almost always the more powerful tool. HELOC rates and what to expect. So rate comparison, it is tied to the primary rate. Currently around 7 to 8% on a primary residence. And then when you compare that to 10 to 15% on hard money and 18 to 22% on credit cards, it's one of the best types of capital we can get to plug gaps and scale faster. So what do these lenders look at? CLTV, mortgage plus HELOC can't exceed 80% of the home value. Credit score must be 660 plus in most cases, 700 for the best rates. And your DTI ratio needs to be under 35%. Now, the real kicker here is if you are maxed out on your credit cards and your DTI is up in the 90s or even 100% maxed out, you can actually negotiate for the HELOC to pay down your debts at a lower monthly payment. As you can see here, the difference in interest you'd be paying on that money actually helps you consolidate that debt super effectively to then be approved for the HELOC itself. Income documentation, so it is an income-based underwriting. Digital lenders will close in as little as 10 days, while traditional banks run 2 to 4 weeks. Key here is it's personally guaranteed. So it is going to go off your personal profile, credit score, your DTI. And that's even if it's an investment property. It's going to be personally guaranteed. Key to note. So what to look for in a HELOC lender? No or low annual fees. Some HELOCs charge 50 to 100 a year to keep the line open. It's not a big deal, but just to be aware of. Interest only draw period. This keeps your monthly costs low while capital is deployed into a deal. You can keep those minimum monthly payments and free up cash as you move through the deal. High LTV on primary residence. So look for lenders going to 85 to 90% CLTV. The higher the LTV, the more equity you can actually access. Fast draw access and no prepayment penalties. So pay down the HELOC when the deal exits and draw again immediately. Some products penalize early repayment, but it's more common on the home equity loans, or the HE loans. So start with the institution where you hold your primary mortgage. They'll often offer preferential terms before you shop externally. But if they don't give you one, there's tens of lenders that you can go and check out. Let's look at how to use a HELOC on an investment deal. So what home equity can actually cover down payment shortfall on investment properties, closing costs at acquisition, initial rehab draws before hard money reimbursement, holding costs during the project, even cash reserves required for a DSCR refinance to season your account. The revolving advantage. So draw 40K to cover the down payment and closing costs on a fix and flip. 5 months later, the property sells, proceeds pay off the draw, and that 40K is immediately available again. No new approval, no underwriting. Cycling 3 or 4 deals through a 100K HELOC over a year means that 100K has functionally funded 300K to 400K worth of deals. So the trade-off here is your home or your investment property is the security for the investment deal. Structure home equity as one layer in a broader stack, not as the sole funding source, and make sure the return on this equity is at least 1.5x. So when you're doing a deal, underwriting the profit you're looking to make, making sure that's 1.5 times, or if you're buying a business, starting a new business, make sure that you can cover at least 1.5 times, whatever you take out. Home equity is part of the 5-tool capital stack that we use here at gapfunded.com. So first you got your hard money, which will cover 70 to 80% of the purchase price. And if you're experienced 100% of the approved rehab, that's your foundation. You've got gap funding. This will be unsecured capital covering down payment shortfall, closing costs, and initial rehab, which can be deployed very quickly, typically within 1 to 3 days. We've got 0% business credit stacking. So this is zero interest capital for rehab draw floats, holding costs and reserves. You can liquidate this via programs like Plastic, Melio, or Bill.com. They do charge a processing fee to do a bank wire, 2.99%. Layer 4 is the HELOC. It's a lower rate revolving capital structured against your home or property investment and can replace or supplement Layer 2, freeing up unsecured gap funding capacity. Layer 5 is a business line of credit. So if you're an established business owner with consistent revenue, 20K plus a month coming in, revolving capital tapped and repaid as deals move. So let's look at a full deal walkthrough, HELOC on a BRRRR deal. So the deal, we're buying at 160 grand. The after rehab value is 230 grand. Rehab budget of 40 grand. After repair rents are 1,500 a month. And then it's 6 months to refinance into a DSCR loan. Your home equity position. So home value is 450. You've got a mortgage balance of 280K. So the HELOC available will be 80% of that difference. So 80 grand at a typical 8% interest rate. Funding the gap of 60 grand, $400. So we got the down payment, 32 grand, closing costs, initial rehab, holding costs, and refi reserves that add up to that 60K 400. How it funded at Gap Funded would be HELOC draw. So 40K, down payment, closing costs, EMD, 0% business credit stack for another 25 grand, which is your rehab float, holding, and reserves. End up out of pocket $0. So 75% cash out refi at 172K 500 pays off all layers. HELOC resets to 80K and your property cash flows at 650 a month with $0 out of your own pocket. So who can use this strategy? If you own a primary residence or an investment property, you must have sufficient equity because at 80% CLTV, the gap between 80% of your property's value and your mortgage balance is what's available. Your credit score must be 660, 700 will get you better rates. DTI is under 35%. The bank underwrites your personal financial profile, not your deal history. So if you are over leveraged, if your DTI is high, you can also use a HELOC to pay that down to be approved. So don't worry too much there. And you've got a verifiable income. So unlike hard money, this is income-based underwriting. So you have to have documentation ready or they may hook into your account via Plaid just to verify that what you've said on the application is in fact true. So a quick equity check. 400K home, 280K mortgage, you've got 80% of 400K equals 320. 320 minus 280 is 40 grand available. If you're at 90% LTV, a HELOC may not be accessible until you've paid down more principal or values have risen. So that's the other beautiful thing is as property prices continue to go up, you're starting to build more and more equity in the home. So over that 10 years you've taken out a HELOC, that revolving line of credit will actually grow if your property's going up in value. Here's some mistakes to avoid. So deploying on weak deals. Home equity is secured against your primary residence or investment property. Only use it on deals where the numbers are strong enough to repay the draw in the worst case scenario. So never use a HELOC as a substitute for deal analysis. Number 2, drawing before hard money is confirmed. Some hard money lenders are sensitive to new liabilities appearing between application and closing. So have the hard money commitment in place first. Number three, forgetting the HELOC cost in your numbers. So a 40K drawn at 8% over 6 months would roughly run you 1.6 grand in interest. It isn't bad. It's one of the cheapest capital options we've got, but it does belong in the deal numbers. So make sure it's part of your underwriting. Number four is leaving the HELOC idle or setting it up too late. An unused HELOC is capital efficiency lost, and traditional banks take 2 to 4 weeks to close. So set it up before you find the deal. Let's go and close something, guys. So if you own a home or an investment property with equity and you're doing real estate deals without deploying that equity, you're working harder than you need to. A HELOC gives you low rate revolving capital that resets every time a deal exits. So combined with hard money and 0% business credit cards, it completes a stack that funds deals at 100% without touching your savings or giving up profit. For a free funding review, find out how much capital you can access across all 5 layers, home equity included. Go to gapfunded.com/book, link in the description below. It's just a softball, no hard credit check, no commitment, 2 minutes, and you walk away with a real game plan in the numbers on your next deal. I'm Mick Wadley. Let's go and close something.